प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome to this Business Today Market Special. Every week we try and speak to one of the best and brightest minds from the Lal Street to try and get a sense of where this bull market is headed. Our guest today on the show is Ridham Desai of Morgan Stanley, a veteran of several decades on the street and one of the staunchest bulls over the last few years. In fact, for the last many years, through many ups and downs, Ridham has consistently been very bullish and has held the view that this is a multi-year bull market which we are very much underway, and we probably are in the early stages of. Ridham, thanks for joining us on the show, and it's good to speak to you again.
Thank you, Udayan. I'm very, very happy to be on the show, and thank you for having me on this.
Great. As I was saying in my introduction, that you are one of the really staunchest bulls for the last many years. And I know that your view is that this is a multi-year bull run. It's shaping up like that. But I want to start by asking you how you feel tactically about the market now after such a strong performance. Say between now and the end of the year or between now and Diwali, how do you feel tactically?
You know, then calling markets for short term is really fraught with grave dangers of going wrong. But you know, I'll still take that risk. I go wrong very often, so maybe one more time. But yeah, we've had a very strong rally, and particularly in the broad market, things do seem a bit overheated. So I won't be surprised if we get some sort of consolidation or correction into the next few weeks. Sentiment looks a little bit overstretched. So yeah, it's good to have that, and it'll be healthy for this market if we get a correction. We're calling for one in the US. Our global team has actually downgraded equities to equal weight after being bullish for several months now since March of 2020. So yeah, I think the stars are aligned for some consolidation and correction. I do think this will be more intense at the stock level than at the index level. So you may not get the type of correction you want, say in the Nifty. It could come, of course, but you know, the individual stocks could do a lot, and you should not be surprised if you know some stocks that have run up a lot go down 10-20% in the forthcoming correction, which is a pretty decent correction. So yeah, I think it may be underway at the individual stock level already, and maybe it extends itself just to make this market a bit more healthy. But again, as I said, you know, calling tactical market moves is not my forte. Yet, you know, I'm going ahead and saying this.
No, it's sporting of you to predict it. But if I were to push you a little further and ask you what you think the likely correction trigger could be, I mean, do you think should essentially be something global? I mean, something on the a message from the Fed or something which is brewing on the horizon, like the Evergrande episode in China. Is there something which you can see which is brewing, which might trigger this 10-15% kind of tactical move down?
Yeah, so then I think it's largely global factors. There aren't any domestic factors that are bearish. In fact, the domestic factors are exactly the opposite. So I do see India outperforming in any type of global correction, which it is. It is actually India is doing quite well. You know, the S&P is already down from its highs, and it's at a monthly low. China has corrected a fair bit. India has actually done quite well. So that I think relative performance for India is intact because India's own domestic policy momentum is far stronger than almost any other country in the world right now. So the correction, I think, likely comes from abroad. We've seen some regulatory tightening in China. We're seeing the prospects of another COVID wave in China, and China has a zero COVID policy, so it will come with some slowdown in growth that could spread to other parts of the world. More importantly, I think we're seeing some pretty big moves in commodity prices due to supply constraints. So, you know, on one hand, you have the semiconductor shortages, which is causing outages for auto production. But on the other hand, you have these coal prices that are going up because of stringent environmental constraints in China. which then in turn is driving up electricity prices, which then is driving up aluminum prices because aluminum production is being curtailed. So it's then driving up natural gas prices in Europe. So there is, a bit of commodity price rise that's happening, which could then translate itself into a cost push. And suddenly, companies may face some margin pressure in the immediate term, and the markets will recognize that ahead of time and correct. So, and then of course, as you rightly said, the Fed is also there on the horizon, and there is a growing opinion, in the world that maybe the Fed is behind the curve. Uh, I'm not so sure about that, but maybe that also gets priced in. So these are all global factors that may play into their respective markets, China and the SPX, and then find its way into India as well. Because after all, we are in a relative world, and India is not a small market. It's the seventh largest stock market in the world. So it won't behave like a mid cap stock in the global equity space. It's going to behave like a large cap stock. So if global indices fall, then India follows suit.
Yep. Now let's come back to earnings, because this market has gone up a lot, and principally in the hope that the earnings cycle will turn around very soon and we'll see a lot of momentum that we haven't seen the likes of over the last 6 or 7 years in terms of earnings in India. Now, I was reading in one of your reports that one of your indicators, which is the leading earnings indicator, is actually predicting that over the next couple of years, earnings growth over a 2-year period compounded could actually be going up by 36%, or it could be going down 15%. So it's a plus 36 and minus 15, within which the range of earnings growth might oscillate. I mean, that's an unusually large range, minus 15 to plus 36. Could you talk a little bit about why there is such a large variance or dichotomy between the top and the bottom end, and which are the factors which could drive it towards each of these extremes? Because on that will hinge the final outcome for the market, right?
Yes, Udayan, and the reason why there is such a wide variance is because we are, I think, in an inflection point with respect to earnings. There's a lot of policy work that has been done over the past 2 years. It started in September of 2019 with the cutting of corporate tax rates, and it marked the shift in government policy away from boosting the share of labor in GDP to boosting the share of profits in GDP. And if you just tolerate me for a couple of minutes, the story goes back to 2006, 2007, when Manrega was enacted. That was a seminal moment with respect to policy choice in India. At that time, corporate profits were booming. Corporate profit share in GDP had gone to around 7%. And Manrega was a moment when the government of the day chose to transfer some of those profits to the labor class. Now, in India, that unfortunately doesn't work very well to drive GDP growth because we have excess labor, and any move to artificially boost wages, it results in inflation, which is what we got eventually once the dust settled on the global financial crisis. And in fact, we went into what we would term as stagflation by 2013. Now, it's taken a long while for policymakers to recognize that may not have been the right policy. For India, actually, where supply constraints are nearly the order of the day, the better outcome comes from boosting corporate profits, therefore investments, therefore you create capacity, then you create jobs, you create wages, and you create consumption. And then you get a virtuous cycle of growth. It was something that happened between 03 and 07 as a consequence of some really tough reforms that were undertaken by the government between 99 and 2004. And I think we saw that shift in policy in September 2019. And it wasn't a one-off. It's been followed by several policies which are directed in the same spirit of boosting the share of profits in GDP. Despite COVID, the government did not relent. So we saw both fiscal as well as non-fiscal measures, so new labor laws, production-linked incentive schemes. More recently, the revoking of the retro tax. We've seen the telecom package, the creation of bad bank. So a lot of things have happened over the past 24 months, which point to the government's commitment to boost the share of profits in GDP. If this commitment stays, then I think we are heading to the upper band. Something like, a 20, 22, 23% compounded annual growth rate in earnings over the next 3, 4 years, I think could be the case. That takes the share of profits from 2% to say 4%. We still don't go back to the peak of 7, but we could still double in terms of share of profits. And if nominal GDP growth is say 10%, and you just do a back of the envelope calculation, you get a compounded annual growth rate of 22, 23%. I think the market has got a little bit of a whiff of this. It's not oblivious to this. The market is damn smart. It gets this, and therefore share prices are trading, faster or higher than what the earnings change has been in recent times. Eventually, of course, earnings will catch up. If they don't, in the event that either you get a reversal in policy, or you get a event globally which causes global growth to slow down, then I think you go to the bear case scenario, and then earnings may not turn out to be the way my base case pictures it.
Okay. Ridham, I want to focus a little bit on the financial segment as well, because in one of your recent reports, and you're of course talking about the opening up of the sovereign bond market and how it will also be a positive for Indian banks in terms of leading to higher growth as well as a better credit growth outlook. If you could just talk us through that and really why you're bullish on not only the larger private banks, even some of the NBFCs on this account.
Yeah, hi Abha. So see, essentially, here's a government that is actually trying to boost foreign flows into the country actively, and it is quite opportunistic in the sense that the world, according to the Morgan Stanley Global View, has moved away from a bipolar situation where China dominated global production and America or the US dominated consumption, to a multipolar world where incremental production could shift to many other locations away from China, and consumption is now growing in many other parts of the world, and will support the US consumption story. So it's a multipolar world. I think the government has understood this opportunity, that a lot of multinational companies want to come and invest in India. So it's opening its doors, and the bond flow move, which was actually tabled in the last budget, where the government has created a new route, the fully accessible route for bonds, what we call as the acronym that we use here is FAR, which allows bond investors to invest into government bonds without actually coming on shore and going through all the approval processes, which can be quite onerous. Now, once you do that, and the only real impediment to this is taxation, which we understand is being fixed between now and the next budget, then you basically, it results in the inclusion of India into the global bond indices. Now, this will result in billions of dollars of inflow. Just the fact that India enters the bond index, in our view, could culminate into $40 billion of inflows into India in a single year. And then you get successive increases in flows as active investors also participate. And of course, subsequent rise in index weight could lead to even more bond flow.
Okay.
What it does is it takes the pressure off the domestic bond market, which is largely borne by banks. And we've for years talked about the crowding out effect, which is whenever government spending goes up, whenever its fiscal deficit goes up, it crowds out private investments. Now, to the extent that some of this is lifted by foreign investors, the pressure on domestic investments to be made by banks is lifted, and those resources, that capital, can then shift into real investments. And then you get better growth and you get better earnings. Of course, the banks also get helped along the way because they actually get better credit growth and they earn better spreads on them and they have better profits. So that's the case for the banks, and I think over the medium term, this could be quite positive for the banks if it turns out the way we are expecting it right now. This is largely a 2022 event, but I think it's a very big event, both for the bond market and I would say even for the equity market. It's going to be pretty large. It's similar to the 1993 moment for FPI flows when the government opened up the markets for foreign portfolio investors, and a lot of active money came in. But 2 years ago, when the government changed the definition for FPI limits and subsumed FPI and FPI limits. It actually resulted in India's weight in the index going up, and passive flows have since then accelerated. And very similar to that, if this happens in the bond market, then I think you get more flows. Simultaneously, I think India's FDI will also rise because I sense that a lot of multinational companies are waiting to invest in India. And the production linked incentives which the government is doling out is hard cash, which is a great message for companies who want to invest, that the government is very serious about it. So I think this is going to result in a pretty large inflow of money across various segments of foreign investments into India.
If you look outside the financial space, Ridham, given what you just told me about earnings and your expectations, what's your best advice in terms of how a portfolio should be constructed at this point in time? I mean, balancing the global risks that you highlighted and the local policy momentum that you spoke about, would you have a more local kind of a tilt to your portfolio or not quite?
Absolutely, Udayan. I preferred buying domestic sectors. So whether it's domestic industrials, domestic consumption, or the financials, rather than looking at companies which are facing outwards. Now, that doesn't mean that they will not grow their earnings. And some of these companies, as we've seen in the tech sector, have a great opportunity in front of them. Coming out of COVID, I think the outsourcing into India is going to actually accelerate. So some of these companies will have a pretty good situation for the next few years. But I feel that the domestic sectors may outperform that opportunity set. So on an absolute basis, while exporters may continue to do well over the next 2-3 years, I think domestic firms may do even better. And domestic firms are coming from a pretty depressed base in terms of demand, in terms of margins. So the upside is much greater.
So I started by asking you a question about the tactical nature of your strategy about the market, but let me now ask you a more medium-term question. Now say if we agree that the bull market really took off sometime in early 2020 after the initial COVID disruption, we are probably say 1.5 years into it. Typically, given your expectations of the earnings cycle, how much longer would you give it? Do you think we are good for another 3 years from here? 2 years, 3 years?
I know this is a very popular question even with our clients, those who invest in the market. But really, it's not a very important thing for me on how long it lasts, because it all depends on how quickly prices rise. And just to illustrate an example, look at the tech bubble. Prices rose very quickly in that period, and it was a very short bull market. But it was a very high return bull market. So it happened quickly. In 18 months, we were all done with it. Whereas if you look at the period between, say, '03 and '07, that bull market lasted 5 years and the returns were far more steady. Eventually, the index, the sensex went up 7-fold in those 5 years. And it lasted that long. So I don't think history is a good guide because there are very few points in history that I have. I have tracked the Sensex from 1985, and there are only 3 or 4 really notable bull markets. There are lots of rallies which give you 70, 80, 90%, but things that where the market doubles has happened very few times. So time is not what I'm really focused on. What I'm focused on is how quickly share prices rise and how quickly earnings respond to that. And if that doesn't go out of control, then this thing can go on for a while. What breaks it eventually is either stocks become too rich or the earnings outlook changes. Usually it's the former rather than the latter, which is the market gets exuberant and then trades at fancy multiples. We haven't really got there. And of course, somebody will walk up and say, no, but the P multiple is already so high. We have to remember that earnings are very depressed. And when you're dealing with change in the cycle, I prefer to use something like price to book, which is a more stable multiple, or price to sales, which is more stable. And those multiples are still okay. They are nowhere close to any previous highs that we have gotten to. So this may have more legs to go.
Ridham, we touched upon concerns around China, but it's also the US Fed that's going to be very much in focus this week. Markets already jittery ahead of that meet, and some speculation that we may see some action, moved forward, perhaps towards November. Again, this is all market talk, and the market's been anticipating this reversal in policy by the Fed for a long time, even though they've been consistently saying that they're sticking to their stance. What's your sense? What can we expect?
See, US economists think taper is coming in terms of balance sheet management from the Fed. But a rate hike is still, a 2023 event. So inflation will have to surprise much on the upside for the Fed to change that view. And in the US, remember, it's not commodities that drive inflation, it's wages. And to the extent that, the labor sector is still got capacity, still got, there is still excess supply there. It may take a while before you actually see wage inflation in the US. So our view is that it will not happen before early 2023. So we're still quite far away. The other thing that I'll add here very quickly is that unless the Fed falls meaningfully behind the curve, the equity markets do not get worried about tightening from the Fed. Actually, the tightening from the Fed is a worry only when growth is weak, not when growth is strong. So I'll give you two examples of history which will resonate with almost everybody. One is the example of 2004 to 2006. The Fed raised interest rate multiple times in that 3-year period, 04 to 07. And none of those rate hikes caused any upheaval in the market. In fact, they were all bought into. The market bought stocks as the Fed raised rates because it was a reconfirmation that growth was strong. And global growth, remember, in that period averaged close to 5%. Then there was another episode in 2013 when the Fed just threatened to taper. And very famously, India lost 20% of its market value in a month. And the currency also fell simultaneously. And that was at a time when growth was not so good. So when growth is strong and the Fed is raising rates, it's not a problem for equities. The problem arises when the Fed is raising rates when growth is not strong because they are worried about inflation. I don't think we have come to that point as yet. So yeah, there will be volatility. And the market is almost, as we discussed at the outset, kind of begging for a correction. So this could be an opportune moment for the market to say, okay, let me correct here, and let this event pass by, and then people will buy into that dip. I still don't see this as a inflation-led tightening by the Fed. It's more reconfirmation that growth is back.
We are out of time, Ridham, but always a pleasure hearing your thoughts. Thank you very much for joining in today.
Thank you very much.
Thank you, Ridham.
That's Ridham Desai of Morgan Stanley, and we are out of time on the Business Today Market Special, but we shall return, as always, Abha and I, coming Monday with another big face from the Indian stock market. Till then.